Ladies and gentlemen, welcome to episode 7 of Living Markets with Liberty here on EBNet Stream. We've had another bumpy month, that's for sure. Roller coaster of a month, which we are now getting used to. Our markets are down nearly 10% for the last 3 months. I wonder how you're surviving this. Well, let's talk to Avi Sumaru, an investment expert from Liberty Corporate Benefits, who is going to update us on what the latest is in our markets. Avi, welcome and thanks for joining us.
Thanks, Leon.
Tell me, 10% down, it sounds like a lot, but off the back of 30% plus last year, it doesn't seem so bad at the end of the day. But the reality is it's a bumpy ride right now. So catch us up on what exactly has been happening and why we are continuing to feel this.
Sure. Like we know with economics, right? It's a whole bunch of factors that play into it. I think the main thing, it's a theme that's been happening since March, is the conflict in the Middle East. With the Strait of Hormuz being closed, you still have those, how do I phrase it? You still have that impacting oil prices the world over. It's causing disruptions, it's squeezing margins, it's impacting sort of inflation as well because of the increase in fuel prices. You're seeing that impacting inflation on the other side. The increase in inflation is giving concerns to potentials for recessions. And all of that starts creating, I guess, a lack of confidence in what's going to happen in the future. The lack of confidence relates to people making varying decisions, going to more secure stuff. You've kind of seen defensive sectors start outperforming because investors have been de-risking and moving to more your defensive stocks. Looking at healthcare, consumer staples, your industrials, right? Inflation has increased. So all of these aspects come together has been causing quite volatile markets. And that's just touching on what's been happening globally. If you bring it more towards what's happening within South Africa, you've had sort of your precious metals and materials kind of decreasing or pulling back. You've had petrol price increases once again due to the war. You had a hike in interest rates. So all of these aspects have caused a lot of concerns, I think, for investors. But relating to the last conversation that we had, these are concerns that are imminent now, that are relevant now for our current times. And it goes back to understanding exactly what you're investing for. If you take this into a longer term view, this volatility doesn't become a concern for now unless you're trying to beat the market for whatever reasons. So your asset managers are trying to obviously seek alpha in this environment. If you take a look at, so obviously the topic that will be top of mind for everyone is the 30 June protests and how that started impacting markets. And the fact that you're going to have potential for protests going on for 6 months is once again still causing more unrest and more uncertainty. And when it comes to uncertainty, a lot of investors don't like that. So you kind of then create that volatility in the market by virtue of also making decisions that move you into more secure stuff. Yeah.
Yeah, so I think there's a couple of things that you said. There's clearly uncertainty. We're resting with a lot of uncertainty at the moment. I still don't know whether the war's off or not, because it seems to be, but then they start shooting at each other again. I don't really understand what exactly is going on. But what I find amazing is clearly uncertainty results in volatility.
Mm.
But when you look at the states, the markets have done pretty well in the states through all of this. So the guys that start the war are the ones that are feeling less of the impact. We're feeling more of the impact because of the oil price. It's hitting inflation. We've had to up interest rates. That's not good for equities. We've got movement to defensive stocks. Why is it hitting us more than them? It just doesn't make any logical sense to me.
Yeah. And I think it comes down to the size of the economy. I mean, if you're looking at the States, you have a massive economy, and you have a massive base that supports it. Whereas in South Africa, you have uh, what is it referred to, the Gini coefficient that we have in South Africa, where you have this large
Quality.
disparity between
Yeah.
income earners, and not a lot of South Africans form part of that higher income earning range. So when you have an increase in fuel prices, it affects a lot more South Africans than it is affecting in the US, as an example, just a proportion of the population. You have a lot of people relying on loans at higher interest rates, um, based on a weaker currency as well. I mean, it's good news that at least Moody's has upgraded our outlook, which has supported us. But I mean, having said that, it does hurt us a lot more. But I feel like uh, the impact to South Africa has been a lot more resilient in the recent year or so compared to years prior to that. I mean, that's just my personal view. It feels like we're bouncing back a lot quicker than we did before. You're not having such a massive impact on our rand value just being depreciated compared to other currencies. And things are holding stronger than it did before.
So I think that's the one thing. The rand has held pretty strong, and while there's been this, I mean, I've never seen volatility like this in 35 years.
Yeah.
And that is because it's almost like false uncertainty as well that's causing that the severity of it all. But
Yeah.
I think what's also happened is America has wrestled a bit of the control of the oil markets,
Mm.
and that's actually boding well for their economy. And they are more resilient than others through that whole process, given their size and because of this power that they've now got. But the pity of that is we are all catching the cold off the back of their little sneeze kind of thing. And it's almost, I want to say it's unfair. It's not right.
I've been preaching that story for I think a couple of years now because it's and it might be unfair for me to say this, but to your point, it's a sneeze in the US, but it has such a massive ripple effect, especially with us in SA. A prime example, and it's one that's stuck top of mind for me because it impacted my ability to go on holiday. In 2021, I think the US had concerns around SA. Um, or the omnivirus emanating from SA, whereas it was our doctors that actually discovered that form of virus. And that's the very different statements. But because of the sentiment of what they believed, it caused massive issues within South Africa. And it took us a while to recover from that, which is also why I'm saying now we are a lot more resilient than we were before. You know, it's going to be quite interesting as how this continues to play out in the future, especially with the can I say expected lower reliance on the dollar going forward as well, or expectation of it.
Expectation. I wonder if that's going to be true. I mean, you also look at
Mm,
alternative currencies like the crypto and so on. That's in the
yeah.
doldrums at the moment, much to my behest. But anyway, so do you have a view on what's going on with crypto and why there's suddenly been such a big fall off on it?
Not directly. I mean, I've been sort of staying away from crypto and viewing it. It causes me too much anxiety. I think the biggest thing about crypto is from what I've seen and experienced thus far is sentiment has been the largest driver of its returns.
Yeah.
One positive comment and it is shooting the lights out on the market, and then a slight concern and it tanks. Um, that's just been my view. I have no clue of what's been happening recently on crypto, to be honest. I've actually been following more the trend on AI, and seeing what's happening there because I think there's been lots of developments happening on that front.
So just
Um,
comment on that if you don't mind, because I almost they're not the same, but I see them in a similar box in the sense
yeah.
that there's struggle to find two other investment opportunities that have as much potential upside
Mm,
than those two. Because the crypto, the potential for the demand to grow is massive if economy starts shifting and crypto becomes more mainstream in that regard. And AI can, I mean, like it's just phenomenal what it can do. And therefore, does AI, and I've heard this story before, not render all financial models obsolete in their thinking, because it's the extent of what it can achieve.
Yeah, not yet. I mean, it's bound to happen. It's going to happen at some point. But I think it just depends on the complexity of models now. You can run very simple, let me not say very simple. You can run your base models through AI. It'll give you sort of accurate results. You can actually get the information that you want to. The data analysis that I've seen it do as well has been amazing. Um, I think there's still some human intervention still needed, obviously to verify it, make sure things are being done correctly. There's no misinterpretation of aspects, especially when you're building a financial model. There's so many intricacies that go into it. I mean, it's like talking about the economy. If you're trying to model the market, you're taking so many aspects into consideration, and how is that being modeled by AI? Is it being considered correctly? Is it creating the right sensitivities to it?
It
Yet.
doesn't. I mean it from the perspective of, I mean, like, you would traditionally think about companies and you would value them and say, well, you expect X, Y, and Z. I mean, like, you can't model what AI could end up being. I mean, I
Mm,
heard you saying there, you still believe there'll need to be human intervention. I believe that's because we're human and we like to believe we need it within the whole thing.
yeah.
I mean, I've been using more and more on AI, and the more I use it, the more I realize Jesus can do more and more what I always thought
Mm,
I was excellent at. So
yeah.
it's eye-opening in that sense.
No, 100%. Sorry, to clarify, is just current world
Mm,
still need some human intervention. And I
mm,
think part of that comment is exactly to your point is us as humans, we want to be able to trust it. So we want to still intervene to make sure that we're
mm,
okay with what it's doing. And until we've built that trust and can fully let go of that control, we're not going to completely rely on AI to
mm.
its full potential. But I mean, definitely in the years to come, actually months to come, those are going to change quite quickly.
So I just think with robotics and AI, you can't sit and say a PE of, I don't know, whatever it is on SpaceX is high,
Mm,
okay, or on Tesla is high, because the potential demand for what they are developing at the moment, I mean, like, it's you can't actually model that. It's impossible to actually model what it is. And if you listen to Elon Musk, where he talks about every man on Earth will have two robots
mm.
serving them, well, that's you just got the biggest boom ever to take place. So we shall see.
Yeah, that's
So
going to be interesting.
I'm hoping, as a tech fundy, and I'd also believe that crypto should have its place. I'm hoping to see some, continued good performance and a reversal from the crypto front. So we'll see.
Yeah, I mean, I'm going to say the controversial thing of crypto definitely needs to be regulated a lot more.
Mm.
And I think once you have that, then the use of it and uh, the reliance on it can be a lot more. You're not going to have that much impact from sentiment really driving it because there's more controls in place. But I know also, with controls in place, it kind of limits what's possible. So it's going to be interesting to see what happens on that front, actually. What sort of regulations come out in terms of managing it? Because, I mean, currently we're not using it in any retirement funding. Reg 28 doesn't allow for it. But like you said, there's going to be huge potential. I mean, there is huge potential for it. It's just when can we actually use it and then start investing in it?
It's funny, people see it as this like voodoo type thing, and it's not. I mean, like, it's just another currency,
Mm,
just done in a slightly different way, and that's where I suppose, the perception comes into the picture. But anyway, let's come back to the real world. You mentioned defensive stocks are benefiting. Can you unpack that a little bit for the audience? What do you mean by defensive stocks, and if you can give an example or two?
Yeah, so I mean, I'm here. I'm talking about things that are your usuals. They're your staples in your environment. Healthcare. There's the base healthcare that everyone's accessing. You're going to be using it. You're going to have to pay for it. It's not things that you can give up because the market's bad. Things that would fall outside of defensive sectors are like car sales, vehicles. Those are the things that you don't need to go and buy a new car today. I mean, especially where how volatile the markets are, you might not want to do that. You want to keep your cash. But there are going to be consumables that you'd want to spend on your bread, milk, and those are the things that sort of stable throughout the different economies. And that's kind of what we refer to as the defensive stocks or sectors.
Okay, cool. And is that been the case here in South Africa and globally, or is it more in the South African scenario?
Globally and within South Africa. So you've seen, I think it's investors worldwide that are kind of just moving to more safer type investments, if I can put it that way. Whether that's the right decision or not is a whole other question. I mean, it goes back to why you're investing. But yeah, definitely seeing it all around.
The oil price went to 100. It came back. Where is it now? Do you know offhand where it is?
Offhand, I don't. I know it's been between 90 and 100.
Yeah, I'm actually going to just Google it quickly. So I just wanted to double check because I know that it recovered nicely off the back of the so-called peace deal, and the opening of the straits. But what's there for the expectation in terms of um, inflation in South Africa off the back of will there be lowered fuel prices at some point in time? What should we expect in that regard? Because that's what's now holding back the interest rates, which will hold back our equity markets.
Yeah, interesting question. I've all my life I've tried not to speculate as much as possible, but I mean having this expectation is quite interesting. Um, the thing is, we've obviously have our 3% point target, and we've already gone above that. We've been trying to keep inflation low, um, but with the price of fuel increasing, CPI has increased, and I think because of those elements, there has been concerns about potentially going into a recession within SA. I think the key thing here is the Saab's probably going to try and keep interest rates low. Um, Going forward, I don't think that there's going to be a change in the short term. I think what are we currently at 7 point? Is it 7.5%? If I'm not mistaken, or 7%. I do think we're gonna try and hold tight at that for the next quarter or so, depending on what's happening, obviously with the war, what's happening with our inflation. So if inflation comes back down, I think we should be good. Yeah.
EBNet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channel by clicking the subscribe button below, share this video with others you think will benefit from it, and give us a thumbs up if you are enjoying the content. That way you help us help you. Thank you from the team at EBNet. For more great content, please visit www.ebnet.co.za.
The Brent crude price is down. It's at 71 something. So from that perspective, it has recovered largely. I would expect at some point in time that filters through again, and that will have relief in terms of the inflationary picture. I don't think in time for the next MPC meeting, but hopefully post that, if everything remains what's the right word, civil in the Middle East, then
Yeah.
hopefully we can see some relief on that side. And then you talk about recession, but I mean the reality is we actually grew GDP faster than expected. By no means near where we need to,
Yeah.
but ahead of the forecast, which was at least pleasing to see.
Yeah, and I mean, besides the Middle East, also, things remain peaceful within SA as well. I mean, if there's unrest there, that's going to cause some noise in the markets as well.
Is there an expectation of that, would you say?
No, there's no expectation of that. I mean, things have largely ended peacefully, but I mean, we don't know what we don't know. I think the knowledge that we have is that there are planned protests to occur regularly for 6 months. It's just, are we able to manage and contain that as well as 30 June, or are they going to get out of hand?
It's also interesting to see as we lead up to the municipal elections and the presidential, what's the right way of putting it? I once called it a presidential race for the ANC, but it's more presidential shenanigans in lieu of the ANC presidency. How that will pan out and impact certain things, and we've already seen this cabinet reshuffle this week. And I was watching a podcast last night, and I just can't remember the one cabinet minister's name, who has been reinstated after she was fired in 2013 for corruption charges by, of all people, Jacob Zuma, who didn't feel her ethics was at the right level. Yet she's now back in cabinet, which was quite an interesting one to watch. And apparently it's more because the ANC Women's League is putting pressure on Cyril Ramaphosa. So it just shows you that there's a lot of maneuvering that's going on behind the scenes, because I cannot believe he's possibly put the person back into parliament.
I mean, you know what? You're going back to an important point. There's so much information or so many things happening on a regular basis. And I think it's just increasing. I mean, if we go back years, I don't think there would have been this much happening all at once at a given point in time. And it's all of this that's also contributing to volatility in the market. I mean, when we spoke last, I think we did talk about how the volatility that we've been seeing over the past couple of years hasn't been things that really existed before. It will happen for brief periods of time, but not so prolonged. I mean, even when we started experiencing, I think it has been from 2020 that we've been experiencing it. Expectation was always like, no, it's going to come to an end. It's going to come to an end. But then there's always something new that happens, because just after COVID, it was the other war that came along, which caused a bunch of noise as well. So now, you have the cabinet reshuffle, you have the war, you have the protest happening. Lots of things just shooting uncertainty again into the market.
But I think we must all also appreciate that as citizens, when something like this happens. I just Google the name. It's Dina Pule.
Yes.
That's been appointed as Social Development Minister. She was terminated because she apparently awarded a 6 million rand contract for some event thing to her, not so much spouse, but her date at the time, back in 2013, and was terminated by Jacob Zuma. Now, what message does that send to the rest of the world and all investors in South Africa? We suddenly seem to be cleaning a few things up with the Matlanga Commission. Guys are either getting shot or getting arrested. So positive signs, and then something like this happens, and you think, what are you doing?
Yeah.
Why would you possibly risk doing something like that?
And then you question, is there progress actually being made?
100%. Anyway, and confidence, like you said earlier, is so important in the investment game in order to attract capital. And the more uncertainty we deliver as a country to the rest of the world, the more uncertain the capital flows will be, and the more volatile our markets will be off the back of it.
Yeah.
Quite simple at the end of the day.
Yep.
So I've been trying to work out in my own head this concept of passive versus active investing, which I've been part of the debates over years and years and years. And I've understood from a South African perspective that our markets are a bit smaller. You can, go kick the tires of companies. You can model those companies' earnings. You can spend a good time getting to know them and making pretty decent calls, if I could put it that way. In South Africa, you got to be careful in terms of indices as well, because we've had a resource bias. So you can have quite a lot of volatility of active fund managers around a resource heavy benchmark. So a lot of people downweight the resources from a benchmark perspective, and active overall has done pretty well from a South African perspective. Fee wise, in South Africa, you're probably paying 20, 25 basis points or so for a passive solution. Active solution in equities, let's say smaller funds, 75, 80 bips. So there's a 50 bip or so differential, and it's been paid for through the active management. So that's all worked out. It's when it comes to global that I struggle. So globally, fund managers in South Africa have been selling global portfolios at the 1%, sometimes 1% plus type level. I don't know exactly what the stats are, but it's something like 60% of all fund managers worldwide underperform the index. And an index solution offshore now you can get basically for free. So how does it make any sense appointing a fund manager in South Africa to manage your global assets, and essentially perhaps paying 1% more, where your chances of underperforming are 6 in 10?
Yeah. That's an extremely good question, because if you were to take a look and taking this dialing this back a bit, the true worth of active management comes in viewing call it inefficiencies in the market. You're looking for this price disparity so you can take advantage of it, or looking for stocks that are going to be performing better, with I guess the market expecting not so much from it. And it ties back to, and you made a good point, where our markets aren't that big. So within the SA markets, you still have a lot of these, call it inefficiencies for now, which is why active management can still seek out those returns in our space. Global markets are quite different. Those markets are massive. There's lots of information flowing around. I mean, like we're saying now, information's flying everywhere. We know what's going on in the US. I think we have a pretty good grasp of it as South Africans. Does the US have a good grasp of what's happening in South Africa? I don't think so. So you can't drive that efficiency within the South African market because the market information is not flowing as quickly, and our markets are quite small. But globally, I think it's the converse, right? And it goes back to the whole move into passive investing, or trackers, where I think it's 90% of investments are in tracker funds globally, and it goes back to, because can active managers outperform markets on the global front? My personal view is it comes down to costs, and that mandates that you're actually seeking, and how are you holding those asset managers accountable. So if asset managers do believe that they can outperform the market, they're probably seeing something that maybe potentially we're missing, right? But paying exorbitant fees is going to eat into those potential returns. If it's eating into those potential returns and you're seeing underperformance against the benchmark, I think as investors, you've got to ask the question of, should I remain in this? How long do I give it a chance to recover? I personally, I believe in passive investing, right? I like it. It suits me as an investor. I'm quite a lazy investor. I like to leave my money and know that it's growing. And I know markets are going to grow because that's just the nature of market. So I don't want to have to worry about stock selection, stock picking, and then is my asset manager performing well enough, right? But so globally, my exposure would want to be, I would want to be passive. I think it's the right move. It's going to be low cost. To your point, you can get it at practically zero. Even within SA, I think, tracker funds are, I think you're saying about 20 bips. It's like 20 to 40 bips around that range. And you're taking on different tracking error risk. So you have some funds that have large tracking error because of how they try to match the market returns, and you have other funds that pretty much track on point. You get a 5 bip difference, and that difference plus the fee that you're paying, you're not getting that much less than the market's giving. And if that's the risk that you're willing to take on, that's the risk that you're willing to take on. But going back to what you were saying is, I don't necessarily see, me personally, don't really necessarily see the need for the global investing, but those that do feel like there is potential there, my view is think about it critically. If you buy into it, but then track it and make sure that you're taking a look at what your asset manager is doing. What is their philosophy? Where are they trying to beat the market? Have an understanding for your mandate that the asset manager is working under. Are they looking at a 50 bip alpha? If they're working at a 50 bip alpha, but you're paying 1% for this, what is your chance of actually earning above market returns? And then is a tracker going to be a better solution?
But I was an investment consultant when exchange control was first relaxed and we had asset swaps, and you could go to 5% and then 10%, and the asset swap rule was taken away. Then you could go to 15, and it's grown and grown and grown. Back then, when we didn't have any offshore exposure, to diversify for some offshore exposure it was no brainer. You had to. From a risk return perspective, it was the right thing to do for all investors. But we accepted, because the limits were low, that we should just go to the limit. So all fund managers, all consultants, all trustees said, right, let's go to the limit that you're allowed to do. The market's now evolved and developed, and the allowances are far greater, yet we've continued to apply the same thinking. Because also back then we didn't say, okay, well, let's look at international fund managers, consider active versus passive. It was 5%, 10%. Just go with your local fund manager and what they can provide in that regard. It's not, the difference is going to be minuscule at the end of the day. But now the market's moved again. We're sitting at far higher levels. So I just don't think that we've paused to go, hang on a second. This is now a lot more meaningful. First of all, should we by default just be at that total limit? I mean, every single rand that's left our shores impacts us as well. Yet we've just blindly sort of gone there. Then secondly, in terms of how we go there, we should consider, because we want a booming asset management industry and a competitive asset management industry, but you've got to compare the South African managers to what else is available. And I'm not certain we've been through those exercises well. And part of what's available is passive. And in the meantime, while exchange controls have been relaxed, passive have gone down to zero sort of fees. So it's become now a far higher hurdle for any fund manager to outperform. So I'm not trying to sit here and say we should only be in passive. I'm trying to sit here and say, guys, we haven't asked the right questions. And it comes down again to the consultant and then the trustees holding accountable, the consultants who should be holding accountable, the asset managers, to say, right, let's scrutinize this. Let's dig in and understand what this is all about. And I just feel as though we've sort of gone, oh, well, another day, keep going. And there's value that's been left on the table as a result of it.
Oh, you're quite right. And I mean, I like managers that are making use of both passive and actives in their strategy for a single portfolio, where you taking advantage of low cost passives to get exposure to certain markets. Because, I mean, let's face it, with the increase in global exposure allowed on Reg 28, most asset managers obviously increase their exposure as well. But can you really outperform global markets? You can get that exposure using passives. There's still that need for active management within South Africa. How long that's going to be there for, we don't know. And then you can create that exposure actively within the South African market, create and generate your alpha in that manner.
So just explain to the audience, how is it possible that a fund manager can offer a product or a service at zero fee? I mean, are they that kind, these fund managers, that they don't charge at all?
I was like, what is it? Economics 101. There's no such thing as a free lunch. So I think that's more on your passive side, right? And you can see with passives as well, there's the most unique things about it is the tracking error that a provider can give you, is their belief in what the optimal strategic asset allocation is. Otherwise, what are the differentiators that you really get with tracker portfolios? There's no different styles like in the active world where you have momentum, you have value management. This is, I don't want to say the same. There's different ways of creating it and different ways of managing it, definitely. But because of the simplicity of it, in inverted commas, that's why it's offered so cheaply. It's you're just getting the market. You don't have someone or a massive team of traders viewing the market stats every single day, trying to make calls, trying to generate alpha. You have the simplistic structure of I'm trying to follow the market. And the best way to do that, obviously, is by investing in the index itself. You can do that through derivatives. And that's what you find a lot of managers doing, is synthetically replicating the market returns, and you can do that quite low cost. And that is how asset managers or managers getting it down to almost zero cost. And with derivatives as well, depending on the derivatives that you purchase, if someone invests 100 Rand, that full 100 Rand may not be used to create that 100 Rand exposure to the market. It might be less. That additional can be used to create additional revenue for the manager themselves. And that's essentially how you can get it down to zero. The question is, how sustainable is that zero market? Because you still need to have that efficiencies to generate that I guess uplift for the manager themselves in order for them to pay for the business that they do, I guess, at the end of the day.
So you're right. The operational costs are way lower. I mean, you need more machine than man at the end
Yeah.
of the day. The other thing is in the physical world of tracking the index, the guys will loan out the shares and take a percentage on that, as well as in trading and rebalancing the portfolio. They'll earn their revenue off the brokerage fees that are ultimately charged. So even when it does come down to the free lunches, so when I encourage trustees to think about these things, is also to dig in a little bit and make sure that they're comfortable then with what the money's used for, and that the costs that are being incurred at that underlying level doesn't erode the potential for the tracking of the index that they sit with. So again, every single thing has not a silver lining that you need to also look out for when considering all of this. But Avi, I see our time is nearly up. I would like to make a request, if you don't mind.
Sure.
There's a lot of noise in the market at the moment around the concept of ETFs, and in particular active ETFs. And I don't think we've unpacked that sufficiently in the market, and in particular for pension funds, and how that might be appropriate and so on going forward. So for our next conversation in a month's time, we'll obviously do our catch up on the volatility and where the markets are at that point. But I'd like to talk a little bit about the ETFs and just shed some light on that, as well as where that market might go over time, because it definitely seems to be an area of growth, and I can see trustees having to deal with that at some point in time as providers start putting that as a vehicle on the table for them to utilize.
Definitely.
Okay. Thank you for joining us. Thanks for the insight, and we will see you again in a month's time.
Thanks so much.
All right. Keep well. Cheers.
Cheers.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families. Financial literacy initiatives to help your employees make the most of their money. And a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.